Welcome to Season 2 of the Generational Dental Wealth Show. Season 2 is all about increasing dental financial IQ. We do record these live in studio at Team Studios, so if you want to see the video format of this show, go ahead to Spotify or YouTube.
Before we hop into today's episode, we wanted to share that this is not legal or financial advice. The thoughts that we share here are our own, and these are for educational purposes only. Kingsley is my CPA. He gives me financial advice. Please seek or solicit the help of your team and your financial advisors for your financial future.
For this episode, we're on the road to Las Vegas, Nevada. The NDA National Dental Association Conference invited us to do a live presentation talking about building generational dental wealth with a tax mindset. We know that you will get as much value out of it as we enjoyed giving. So go ahead and join us and let's hop into it.
So please do me a favor, because it always makes me feel good when I get a heartfelt warm welcome for our guest, our tax expert CPA, Kingsley Ifedi.
Yes, sir. Thank you. Perfect. Well, good afternoon. I appreciate everybody joining this afternoon. I know it's been a long weekend, enjoyable. Las Vegas, I'm sure it's been fun. I know I've had a lot of fun. So we'll be touching on building generational dental wealth with a tax mindset. We'll be hopping into some different tax strategies, and we'll go ahead and get some value out of this today. So before we hop into it, like I said, there's some different stages that we like to focus on in our show, and just what we believe in as a brand. And those 5 stages, and I'll touch on them briefly, but we'll be obviously focused on stage 2 here. Stage 1 is rich life discovery. So what we like to do is kind of come in, take a look at what do you want. Like I said, finances are very personal. Everybody here is a little bit different on what they want and what they're looking for out of kind of that longevity of life here. Stage 2, tax strategy. I always say this, right? Taxes, and you're going to see on the next slide, taxes are the biggest inhibitor to building your wealth. So we want to come up with a tax strategy and have a plan and maintain that plan. A lot of people sit down and create a plan, but they don't maintain it. They don't take it serious. But we try to make sure that our clients are well taken care of there. Stage 3, extreme ownership. So just taking control of your financial situation, implementing those financial guardrails. We'll talk about what that means. Stage 4, asset accumulation. This is one of my favorite, building that portfolio of cash flowing, appreciating assets. Yes, both, right? Cash flowing and appreciating, those are not the same thing, but we do take that really serious. We look at different investments that can create both in your life, right? Because we want those values to go up, and also we want them to be kicking you pretty much back a dividend every now and then, right? Best of both worlds there. Stage 5, legacy. We're not going to hop too much into it, but at the end of the day, right, we're all here for someone bigger than us. We're all here for a purpose bigger than us. And it's not just dentistry, right? As you all would probably agree with me. Like I said, we'll be focused mainly on stage 2 here today, tax strategy. Let's hop into it. Let's see. Perfect. So let's talk about it. Dirty 5-letter word. We all love it. We all hate it. Taxes. So how many people in here, I just want to get a kind of a poll and maybe a few answers from the audience. How much percentage of your life do you think you work to pay the government? How much percentage of your life? Between 1 and 100%? 85%, 40%? 35%? Who said 35? Bingo, 35% back there. Yeah, so, this is the bad news, and what happened to the good news, obviously? Bad news, right? On average, and obviously some people are higher, some people are lower. On average, most dentists spend about 35% of their working life dedicated to paying the government. I like to call it a silent partnership. It might not even be so silent because at the end of the day, right, they're coming off the top, right? Before you even get your check a lot of times. So what that means is 4 months out of every year, right? 4 out of 12 months typically is dedicated for you paying Uncle Sam. Right, and my job, right, is to see how we can get some of your time back, because you all work very hard and you all obviously deserve that money back into your pockets. Second thing here, taxes are your largest expense and will be either the biggest inhibitor or the biggest accelerator to you building your wealth. Because of percentage base, like I said, if you make an extra $1, same 35% applies across the board, right? It's not like your mortgage expense where it's flat. It's not like your other expenses, maybe auto expenses. It scales up as you scale up, right? Silent partnership. See, but like I said, good news. I come with good news. Good news, there's about 7,000 pages of tax code. I'll be honest, very few people in this world are sitting down to read every single page, but that's why I'm here to make it easy for you, right? About 99.5% of the tax code is created to help you save money. I know there's a lot of big misconceptions. The IRS is here to take all your money and Lord knows what is done with it, but I'll be honest. Pretty much every line of the tax code is created to help you reduce your taxes, if you know how to. So, with that being said, that's what we're going to do a little bit today, right? So, what I wanted to do, wanted to take you all kind of through a real life case study of a client that I have come in, and just some different things that we like to kind of take a look at when it comes to taxes and tax strategies. So I would just encourage you, put yourself in these shoes. Obviously, your situation might be a little bit different, but we wanted to put together practical tax strategies for you to take away with today. So, obviously changed the name here, but Dr. Jane Doe, DDS, he looks like he's 38 years old. He's married to Jane Smith, a stay-at-home mom, and all of these facts, before I hop into it, are going to come later in this presentation. So take note, take a mental picture, right? Because you might see these facts and think, oh, right, that's just an everyday dentist. But as a tax strategy, I salivate because all of these situations mean something to me, and it means something to this person's tax plan, all right? So, children, has 2 children, ages 9 and 14. Residence, resides in beautiful Houston, Texas. I don't know if we got anybody from Houston in here. Shout out Houston. Practice, he has a new dental practice. He does about $800,000 in collections annually, but has a take-home profit about $300,000, right? Before we hop into it, obviously, when we're talking most things tax, we're going to be talking about the net profit, right? What's left over after your expenses. So that number is really important, the $300,000. He owns a practice building, really important. And then the equipment and furniture are outdated, right? So he came into a situation where he's looking to upgrade some things, get some different things in the practice. Business structure. He operates under an LLC, and he's taxed as a single member LLC. Really important. Additional info here, recently purchased a Cybertruck. Shout out all my Tesla owners in here. And he loves to travel with his wife, right? Just some additional details there. Last detail up here, he does work 1 day per week doing 1099 travel dentistry, local tenant, and he's interested in investing in real estate. So anyways, you can identify with at least a few things up here. So this is about the moment when John Doe walks in and his eyes get really big, I'll say that. So the first thing that we like to do is get really clear. We like to get really real, just like I'm sure most of you do when you have patients walk in, where you have to do that evaluation, see where this patient is, where you need to take this patient. So that's what we like to do. We like to get really clear on where this client is. So we do something we call a tax projection. And that's just saying, let's take a look at all of your income for the practice. Let's take a look at all your spouse's income. Let's take a look at your entire tax landscape, and let's just put a number on what we think you will owe next year come tax time. And that is really important from the simple fact that there is a difference between tax paying season and tax saving season. You know, a lot of people are used to tax paying season, and that's why many people don't look forward to hearing about these topics. But we have such a great opportunity before December 31 to implement some things during tax saving season. Last point here, tax preparer versus tax strategist. It's a huge difference. You know, most of you probably go to a tax preparer or you prepare your own taxes. That's great. There's obviously is room for that. But if you want to take it a step further and really be in control, tax strategy is where that comes into place, and the tax strategist will be serving you best in that area. Because most tax preparers are just looking to file what you give them, right? They're not looking to tell you how you can take advantage of any tax strategies. So for the most part, this client here had about $105,000 of projected tax due. Like I said, this is about the moment where clients are ready to crash out and get upset, but we're going to do something about that here. So What I wanted to do was just put together about 7 tax strategies. Obviously, this is not the exhaustive list. When a client comes in, we're looking at so many different factors. But for the most part, these were the 7 that I identified. That's just really important that I wanted to communicate today. So in general, first thing that we're looking at, like the slide said before, he owns a primary residence in Houston, right? So we wanted to look at something called the Augusta Rule. Has anybody heard of the Augusta Rule by any chance? Okay, we have a few in here. It's popular. So the Augusta Rule was named after, obviously, the Augusta tournament, the golf tournament in Augusta, Georgia. What happened was a lot of taxpayers, right, were living, or maybe they had a side residence, and they wanted to step away for a few weeks during the tournament and rent out their home. So what ended up happening was the IRS allowed for 14 days for your primary residence to be rented out without you having to claim that as taxable income. And on the flip side, it allows the business to take the rental expense as a business deduction. So I'll kind of break down what that means. So, like I said, that sweet spot is 14 days. If you go over 14 days, the IRS considers you a rental property. So we do want to stay under that 14 days. So you might be asking yourself, and before we hop into it as well, I know everybody in here may not be a business owner, but there are ways that even as an associate, even as someone who mainly on a W-2, for us to involve some of this in your tax planning, right? At the end of the day, you may not necessarily own the dental practice, but you may have an ability to own, obviously, the way you receive some of your income, even if that's just on a 1 or 2 times a month basis. There are some creative ways that we can kind of shuffle some of these tax strategies in, even if you're an associate. So just stay with me here. Don't check out, all right? Cool. So, like I said, Augusta Rule, what ends up happening is, let's say that you, the individual, signs a lease with your business or signs a lease with your practice. And what you can do is, if you just do some pretty much, we like to call it just reasonable rental study, what we can do is we can take a look at what are all of the different properties around your area you're renting for. Let's say on the higher end, this won't be applicable for everybody, but let's just say on the higher end, your personal property can rent for $1,000 a night or $1,000 a day, right? What that means is for up to 14 days during a year, your business can pay you, the individual, $1,000 a day for 14 days. So like I said, that's a $14,000 tax deduction to the business, while that is a $14,000 income to you that you never have to claim. The IRS won't tax you on it. It's like you just got a $14,000 bonus without having to pay any taxes on it, right? Huge one right there. Different things that you can do. You can obviously utilize your home for different employee retreats, board meetings, etc., right? Get creative with this. At the end of the day, these tax deductions are there for you. All right. Second tax strategy here, home office deduction. So like I said, just taking a look at, and I'm gonna get to you. I'll get to you out right after this. Second tax strategy, is really still looking at the home, right? What are the other elements of the home that we can take a look at, right? And that's having a home office. Now, many of you might think, okay, right, what does that mean? It literally just means having a dedicated space in your home. It doesn't have to be a full-blown office, but a dedicated space that you use for business purposes, right? And what that means is there's actually 2 options that we can take. And we like to see which one is going to maximize your tax situation. So the first option is the simplified method. Obviously very straightforward, $5 per square feet up to 300 square feet. So if you have an office that's 300 square feet, you max it out, $5 per square foot. Your tax deduction is $1,500. Very simple. It's very easy. Most people may or may not go this route depending on, like I said, the size of their home office. The second one that I like to recommend is the actual expenses method. And what that means is we like to see what is the percentage of your home office size compared to your entire home size. So most people fall in between about 15 to 20% of their actual home office is pretty much relative to their entire home. What that means is we can deduct, let's say if you have $20,000 in home expenses for the year, we take that $20,000 of all your home expenses, so that can be utilities, that can be rent, that can be your maintenance, that can be lawn care, and we multiply it by the percentage that your home office, so about 20%. Tax deduction can be huge, right? Because these are already expenses that you're paying that you're not getting a tax deduction for. I don't know anybody who's getting a tax deduction without this for their utilities, right? It just doesn't happen, right? So we're taking expenses that you're already paying for and we're making them deductible, which is the key to all of this. So here we see that, for the most part, with this client, the tax deduction was about $9,000 when we implemented this strategy. And just real quick before we go on, the coupons are just what I like to think about when we have that final tax bill, these are decreasing that final tax bill. So all these coupons are going to add up as we move forward here. Second thing, this is probably one of my favorite here, because like I said earlier, I really believe in the American dream. And before we hop into this strategy, leveraging payroll for your children, I just want to say, I come from a family business. You know, my parents, since I was small, running around in diapers, had a family business. They had a home health care business. So it taught me what it looked like to be a part of something with my family. And I took this very seriously, right? Because it pays dividends. So I don't want to just talk about a strategy for the sake of taxes when they have so much real life benefits. And this is probably one of my favorite here. So what does this mean? Leveraging payroll for your children. So hopping into it, how to pay your children. So really what we're trying to do is, the IRS says, as long as someone, anybody, it can be anybody in here, it can be children, anybody, as long as you get, for your first $14,600, if you're single, you don't have to pay taxes on that money. It's called a standard deduction. If you're married, then it's double, right? Everybody has a standard deduction depending on your filing status. Long story short, what we're trying to do with this strategy is we want to pay the child or your children up to $14,600. The reason being, we don't want that to be taxable income to the child. But the business, right, like I said, even if you're 1099, even if we figure out how to mix you in and get you some 1099 income, the business can get a tax deduction for that same amount, right? That's just wages and salary expense. So the business can take a tax deduction for up to $14,600 as well. Now, one thing I do want to say, you do want to have a bona fide reason for them working in the business, right? And this isn't just a tax strategy, throwing them down on paper and we're just writing things off. This is, bring them into the office every Saturday, or during the summer, just like we're in now, bring them in a few times during the week and go ahead and give them a role. I just wanted to put 5 just great job descriptions, and these job descriptions that I have my clients even have their children, right? And that's junior admin, right? Shredding paper. We all know that's really important. Get things HIPAA compliant, get things around the office organized. Cleaning helper. We all know, I mean, if you're in a practice or if you have a practice, we all know that's really important, right? Keeping things tidy. Supply organizer. I mean, I'm sure some of our supply cabinets are a little bit messy from time to time. Get them to organize that supply cabinet. Brand ambassador and social media coordinator. No matter what age they are, all these kids know social media. And if they don't, they know it better than any of us in here, even 5-year-olds, right? So get them to run that TikTok page, get them to run that Instagram page, and get them moving and get them active into your business. Now, most people stop there. And that's why I tell my clients, we don't want to stop there, right? We don't want to just take that tax deduction. We want to keep going. Children with earned income. Now, legally, they have earned income. What we can do is we can open them up a custodial IRA account, a custodial individual retirement account. And we can fund that up to $7,000 per year, this is like a ×2 bonus, right? Not only are we paying them, we're helping them contribute to their retirement account while they're still underage, which is huge. So with that being said, I know when we think about retirement, right, IRA, we think about retirement, right? But the biggest thing with this, there are exclusions that how the child can touch this money before retirement, right? We all know if you take money out before typically retirement account, you get penalized, you get taxed on that income. But such things as first-time home buyers, so up to $10,000 they can take out without facing any penalties there, right? So really important with the IRAs. So just for the most part, now we're building generational dental wealth because we're multiplying this now. Have we had 2 questions? Sorry about that. Yeah.
I just want to leverage this tax strategy. I have a toddler at home and I have trouble finding a suitable job description for the toddler. Do you have any suggestions for that age range?
How old are they?
19 months.
19, oh, that's tough. It's tough, but if you're in pediatrics, right, and in general, it's tough. I do see around 7, 8, 9s when they can physically do a legitimate job. But at the same time, they can be a social media brand ambassador, right? They're the face of what you're doing, right? People love to see kids smiling and running around and being a part of it. So, right, it is harder at that age, but there are 1 or 2 ways that we can really try to, try to talk about. So great question. Yeah, we had 2 more questions. Yeah, we'll get the one in the back first.
I was wondering about the office. Now, we used to be broken down so many limitations that it had to only be for dealing with, or could it be an
Yeah.
other things. Is that correct?
Yes, correct. So one thing I'll say about the home office, and obviously I'm not the IRS, so I can't speak on behalf of the IRS, but I will say the home office was one of the more flagged items back in the day before we had a remote working environment. So sub 2010-ish, and especially before COVID, people weren't working from home like that. But now IRS, at least in my experience, I'll speak from my experience, this is one of the areas that are wide open. Because at the end of the day, everybody takes their notes home, to do some work, they're finishing up, eating dinner, whatever like that. Everybody needs an ability to be able to take work home these days. So it is more popular, and the IRS doesn't flag it, at least in my experience. We have one more question?
Yeah, I was for the Augusta rule.
Yeah.
What sort of paperwork needs to be generated for any sort of auditing purposes that might come up later? Are you looking at prices on Airbnb in order to determine kind of like entry rates or rental per month, that sort of thing?
Great question. So I actually give my clients, and I don't mind sending it out. If anybody shoots me an email, I'll give you any resources that we talk about today. We actually have something called, it's pretty much a lease agreement between the business and you. It actually has on the second page the ability for you to find 2 comparable properties to you. So that could be Airbnb, VRBO, the local hotel. But one thing to keep in mind, the hotel or Airbnb is supplying the rental for the home, but they're not supplying amenities. When they're at your house now, then you can supply them coffee, snacks, access to the pool, different things. So they might charge $300 a night, but you may reasonably be able to say why you can charge $600 because you're not just supplying a space for people to meet, you're supplying some amenities as well. So really good question. We got any other questions? Cool. How we doing on time? We good? Okay. Okay. We'll try to speed up here, man. Cool. So some of these, I won't go too much in, right? Obviously, this is too much for one session, but I want to give the broad strokes. In general, next thing we looked at tax strategy for was selecting the optimal tax entity. Now, one misconception that I get probably more than any, I'll be honest, is does an LLC save me in taxes? And the answer is no. Straight out, no. Single member LLC doesn't save you anything more in taxes, even if you didn't have an LLC. Right? If you were a 1099 contract, you had no LLC, it doesn't save you anything because it is a legal entity. You go to your Secretary of State, you file some paperwork, you get your articles of organization, and that's that. You have a great legal entity, separates you for asset protection purposes. Keeps you out of trouble if the business does anything or the practice does anything, it doesn't come back onto you personally. That's what that's for. Now there's a difference between a legal entity and a taxable entity. Taxable entity is typically going to be dealing with the IRS or any type of taxable agency that you're dealing with. That's how they're going to view you. And in this case, what we wanted to do, like we saw in the prior slide, he was just taxed as a single member LLC. So if anybody knows, following the Schedule C, that's that, right? You're getting hit so hard on self-employment tax, right? And we're going to talk about what that means. But as an S corporation, right, and most dentists, I'll be honest, probably 100% of our clients that come in, they're all S corporations. It's just the most popular, it's the most easiest, it just makes the most sense, especially with higher income earning type of practices, right? What an S corporation is, it allows you to split out your income. So, like I said before, as a single member LLC, you claim all of your income and expenses and they're all dedicated to you. Now as an S corporation, you get to break it out a little bit because you are the owner, the shareholder of the business, and you are an employee of the business. So you get to separate out your income into 2 different buckets. What that means is W-2 wages, and like I said, you don't have to have a practice. Even if you have a 1099 and you're receiving some contractor income, we can get you into an S corp. It's not an issue, or your accountant can get you into an S corp. But what that means is for the W-2 wages, right, we have to look at something called reasonable compensation, and we'll kind of talk about why that's important. And then for the K-1 distribution, that portion is not taxed at all with self-employment tax. So I have a quick example on what this means. Let's see. I'll try to run through this pretty quick. How is your LLC taxed? So taking a quick example of $100,000 regular income, your LLC is just a flow through disregarded entity, right? Doesn't do much. All of that $100,000 is subject to 2 different taxes. So it's subject to your self-employment tax, 15.3%, right? You're paying employer and employee portion now, right? So it's 15.3 total. And then you're also subject to your ordinary income tax rate. So in this example, 20%. So total tax about 35%. So you're getting hit on both sides. As an S corporation, As an S corporation, you get to break things out a little bit. So you get two different buckets now. Like I said, you're a shareholder of your business, you're a shareholder of your corporation, and then you're also an employee of your corporation. So what happens is the same $100,000 of income, you get to split it up, like I said, in two buckets. And for the salary portion, just like many of you may be associates today, you're paying your FICA tax, and your business or whoever you're working for is matching that FICA, right? That's Social Security and Medicare. They're matching that. So on that portion of your income is 15.3% tax. In this example, right, we're trying to pretty much cut it in half at least. We're trying to at least split your income down the middle. Now, that's not a perfect example. There's more to it. But in this example, that's what we're trying to do. And then on the remaining portion of the income that you have, what we went ahead and did was we just had that as a K-1 distribution. So what that means is there's no self-employment tax because the IRS consider that as income that you made in a passive manner a little bit, right? Like, for the most part, you made that not necessarily working in it. So you're not necessarily self-employed when they're looking at that type of income. Long story short, all things considered, total tax savings of about $9,000. And that's just considering, this isn't even money that you're spending. This is just considering what type of entity we want to put you in, because not all entities are created equal here.